almost always start by thanking the fine folks at FX Street. Thank you, folks. Seriously, I really enjoy doing these webinars, and feel like it's a privilege and honor to do so. And in fact, I still to this day, and I feel this way every day, every time I start my coaching session at FX Bootcamp, or whether it's that or a webinar here at FX Street. I still felt so cool, so neat to be speaking with, to be chatting or having a conversation with people from all around the world who have common interests. In this case, trading the foreign exchange market. So it's really something I hardly could have imagined doing when I was in college, let alone maybe 10 or 15 years ago. I guess I could have imagined it that long ago because we had the internet going by then. But anyway, really indeed to do this, and really enjoy doing it. So notice the weaker dollar, weaker yen, weaker Swiss franc here. But let's get started. Let's set up a little format here. Many of you are familiar with the format of this event. I usually take a look back at the trading day that's passed, the trading day we just finished. In this case, Thursday, September, 22nd. And we view one or two trades, which were arguably highlights of the trading day for foreign exchange traders. And I'll take a look ahead at tomorrow, what tomorrow might bring in terms of news, maybe speak to some certain technical levels on certain currency pairs, and once in a while we'll talk about a sort of a side topic that may be of interest to traders in this attending this event. So with that, let's get started. The first thing I want to cover, and this is one of the topics that I covered in my live coaching session at FX Bootcamp today. The first thing I want to cover is this so-called Operation Twist. Who has already heard the term Operation Twist? Now, actually, I want to especially hear from the folks who've heard the phrase Operation Twist, but not quite sure what it means. And by the way, do not feel bad if you don't understand what Operation Twist refers to. Because I will say this, as I was talking about Operation Twist in my live coaching session, at least one of our currency coaches at FX Bootcamp, by his questions and by his comments, seemed to be scratching his head, seemed to be a little confused about what Operation Twist meant. So you know what it is, but don't know how it actually works. By the way, this volatility you're seeing, it's not uncommon to see volatility increase at the start of a trading session. We're essentially at the open of the Asian session, and we see some pairs taking off here a little bit. Let me make sure I'm not aware of any news flow, but not that we're going to get too wrapped up in the current price action. This is one of those things where, if you were looking to trade this, you were already in, or you're looking for pullbacks here. And by the way, sometimes there are head fakes. Sometimes we get a head fake, a move in one direction around the Asian Open, which is about now, and eventually I flip the other way. Although these are a little bigger than your average head fakes. And actually, one of you made a comment earlier about the G20 meeting and the weekend approaching, and maybe some short covering. Now, that's very possible. Very possible. I cannot disagree there. So let's get to Operation Twist. What's that all about? Well, we had the Federal Open Market Committee conduct a 2-day meeting. I've talked about this in a prior FX Street webinars this week. The Federal Open Market Committee, that's the group representing the Federal Reserve, the U.S. Central Bank, the groups that decides on monetary policy on behalf of that central bank. They had a 2-day meeting starting Tuesday, ending yesterday, a 2-day meeting, actually maybe 2 days ago for some of you. It's already Friday for some of you. So they had a 2-day meeting, which is interesting because let me give you a little background here. This month's FOMC meeting was originally scheduled to be a 1-day meeting. Well, Federal Reserve Chairman Ben Bernanke at a presentation, actually at a speech at a Jackson Hole Symposium in Jackson Hole, Wyoming, in late August. The Federal Reserve Chairman makes a speech every year at that symposium. It's actually a conference involving central bankers, especially central bankers from major developed economies from around the world. So central bankers convene there in Jackson Hole, Wyoming. Nice place. They chat it up. And Bernanke makes a speech. Well, at the Jackson Hole speech last year, he essentially drops some heavy hints about the so-called QE2 program, this quantitative easing program that was launched in November of last year. At this most recent speech, Jackson Hole speech in late August, late last month, one of the comments he made was about this month's FOMC meeting, and what he said was they were going to expand the meeting from the original scheduled 1-day meeting to make it a 2-day meeting. Now, as I recall, he described, expanding it to a 2-day meeting to, to prompt or to make time for a fuller discussion. Recall him using those two words, to make for a fuller discussion, fuller discussion amongst the FOMC voting members as to what to do next, if there was anything to do next. So, what that did, at least in my mind, what that did was create some maybe some heightened expectations in the market that the Fed might do something significant, maybe more significant than what they actually did. But I'll get into that in a minute. So there's been some building market expectations about the Fed doing something significant. Well, one thing that caught my attention was a survey conducted by CNBC, the financial news network based here in the U.S. Some of you may have access to that even around the world. CNBC did a survey of money managers. I recall they surveyed something like 60 money managers money managers are responsible for, a good chunk of funds. And I don't recall the exact percentages, but I believe about 70%, roughly 70% of them expected not only a so-called Operation Twist introduced by the Fed, but they even surmised that the Fed would do something like $400 billion worth of Operation Twist, and I'll explain what that means in a moment. So there was a relatively high proportion of money managers surveyed expected at least something like what the Fed actually announced yesterday afternoon in the New York Times. So there was a lot of market expectations of the Fed doing at least a baseline so-called Operation Twist, which again I'll explain in a minute. But I got to think with that proportion of money managers expecting Operation Twist at a minimum, there were probably some expectations of even more than that, especially when you consider, as I mentioned earlier, that the Fed expanded the meeting from 1 day to 2. My guess was even with the 1-day meeting, it was fair for markets to expect that the Fed would at least do something like an Operation Twist. Anyway, here's what happened. The Fed made its announcement, and yes, indeed, they announced what's called Operation Twist, which in just a moment I will explain what that means. Now, what I found interesting, I'll show you the price action in a moment. What I find interesting is that you get the impression from the price action on the dollar especially that the market wasn't too thrilled with what it got, what it heard from the Fed, not only in terms of what Operation Twist was, but especially the Fed's references to their economic outlook. But anyway, so let's explain a bit what Operation Twist means, and I'm still in search actually of an analogy. So let's explain a bit what Operation Twist what that means. Well, in the course of its prior to quantitative easing programs, the Fed has accumulated quite a bit in terms of Treasury securities. In fact, I could refer you real quickly. I actually queued up a lot of websites to cover this in this webinar, but this is one I didn't queue up, and I want to queue that up now. I'm going to the Cleveland Fed's website. Again, the Cleveland Fed's website, and what they offer is a graphic showing essentially the Fed's portfolio of assets. So essentially what I'm doing is I'm doing a Google search on Cleveland Fed, and it'll take me to their website, and I'm going to show you a graphic on the website, which will maybe help me conduct my explanation of what Operation Twist is all about. So you go to Cleveland Fed's website, and I'm looking at this graphic called Credit Easing Policy Tools. Credit Easing Policy Tools. That is a look essentially at the Fed's balance sheet, and I'm going to click on that. What you're going to see in this graphic, and this graphic starts and it shows data of Fed holdings. So what you're seeing is assets held by the Federal Reserve, again, the U.S. Central Bank. And this thing's almost drawn up here. And you can see the legend for the graph here at the bottom. Now, one area that has my attention here is the area of long-term Treasury purchases. Long-term Treasury purchases. That was from QE1 and QE2 at work there. Long-term Treasury purchases. So let's get down to what does Operation Twist mean? Well, the Fed has accumulated over the course of its quantitative easing programs. The first one announced after the Lehman Brothers bankruptcy in late 2008. The second one announced, again, as I mentioned earlier, in November of last year. Through these programs, the Fed has accumulated a great number, hundreds of billions of dollars worth of U.S. Treasury securities. The intent there, by accumulating Treasury securities, the Fed has brought down longer-term rates. It's also put put a great deal of money, a great deal of dollars into the U.S. banking system, and that's the intent there was that the hope was to get at least number one, to provide the U.S. banks some liquidity, and eventually hoping to encourage the banks to lend, and also bringing down longer-term rates that make it more feasible for say consumers to buy homes, consumers to say what I want to say, not repurchase, but I'm at loss for the term here. Refinance their home. That's it. Refinance their homes. Stuff like that. Bring down rates that are the basis for, say, credit card loans, mortgages, stuff like that. So anyway, the Fed has accumulated all these not only mortgage-backed securities, but particularly Treasury securities. So what the Fed has, and again, it's represented by these by this orange and gold-colored area here, which if you look at the total is like 1.6, 1.7 trillion total of U.S. Treasury securities. The Fed has all these different Treasury securities, like 2-year notes, 3-year notes, 5-year notes, 10-year notes, 30-year bonds. But a lot of those Treasury securities are of what's called shorter denominations, the shorter term stuff, like 2-year notes and 3-year notes, even some bills. The Fed has some Treasury bills, like 1 month, 3 months, 6 months bills. What the Fed is intending to do with Operation Twist is simply dump, actually to the tune of maybe $400 billion worth, dump some of its shorter-term holdings, like, again, the 1 month, 3 month, 6 month bills up to 3 month notes. Dump the shorter-term stuff, the stuff that will mature, within the next 3 years, and use the proceeds or the money it makes from dumping those in the market, from selling those in the market. The Fed's going to use the proceeds from selling the shorter-term stuff to invest in longer-term stuff, like 5-year notes, 10-year notes, even 30-year bonds. So the Fed is effectively shifting its portfolio. The overall balance of the Fed's overall level of Treasury securities not really going to significantly change. In fact, it's going to pretty much remain flat. So unlike QE1, unlike QE2, the Fed's not going to accumulate any more, at least not a significant amount of new overall Treasury security holdings. Its overall balance, its overall level of U.S. Treasury securities is not going to increase. So you might call this a baby step in terms of stimulus. If you want to boil it down to simple terms, this is a sort of a baby stimulus step. I mean, it's much smaller, a much lighter step than the prior programs, QE1 and QE2, where the Fed, especially QE1. I mean, there was a QE1 step where the Fed bumped up its plans to buy agency mortgage-backed securities and also Treasury securities, something like north of $1 trillion, and I'll mention that in a moment. The Fed announced its intent to bump up its balance sheet by more than $1 trillion back in, as I recall, March of 2009. So compared to those big steps the Fed made with QE1 back in late 2008 or 2009, and then QE2 announced and started back in November of last year, compared to those steps, this step announced yesterday, a relative baby step, a small step. So part of the story is this. There may be a sense that the market's a bit disappointed that the Fed didn't do more. And arguably, it's the one central bank that's seemingly independent enough to do something. And especially when you consider what's happening in Washington, D.C. right now. You've got, political gridlock with Congress there, and the White House and Congress don't see eye to eye and not getting along very well. So, and plus there's some increasing sensitivity to, spending more, to fiscal stimulus, given what the tension on, sovereign ratings and such that, of course, we just had a recent sovereign downgrade of the U.S.'s credit rating. So the environment for more spending from Washington, D.C. is not so good. So markets and, of course, for this matter, some politicians in the country are looking to the Fed to provide the stimulus. Well, the Fed did a little bit of stimulus here, but number one, the effects of this stimulus are debatable. The effects of this Operation Twist are debatable. In fact, the overall effects of QE1 and 2 in some people's minds are debatable. And number two, you could argue that the market's expecting more. But that's probably not the biggest, or certainly not the only reason why markets reacted the way they did yesterday, and actually earlier today for me. So let me get to as I saw, one of the other bigger, maybe the bigger reason why the market sold off so sharply. I've gone to a web page here showing the FOMC statement. This is the FOMC statement released a little after 2 p.m., about 2:20 p.m. yesterday. And if there is one statement you can pinpoint that really, if anything, probably spooked the market, it's this one, the one I've highlighted near the middle of this page. The FOMC said there are significant downside risks to the economic outlook, including strains in global financial markets. Well, that may not sound like much to many of you, but I'm telling you, when it comes to central bankers speak, especially Fed speak, significant downside risk, that combination of three words strung together, that's some pretty heavy talk from a central banker. The term significant isn't used too lightly. At least in my view. I've read plenty of FOMC statements and plenty of just Fed speeches and such, and that's a pretty heavy phrase. That's a pretty meaningful statement. Pretty meaningful stuff. So my guess is that does the Fed underwhelm the market? Maybe that's part of it. As the market spooked about the Fed outlook, that's probably part of it too. Jason, that's a good question. My answer, number one, you have a more hawkish Fed this year. Jason, if we had the same makeup of FOMC voting members this year as we had last year, you might see a little more policy stimulus out of the Fed at this time. You might see a little more QE or something like lower interest on excess reserves. But what changed from last year to this year, you have more voting members this year that are far more concerned about inflation. So it's a more hawkish Fed this year. The hawks are the central bankers who are much more concerned about the future prospect of inflation. The so-called doves are more inclined to provide more policy stimulus and concerned about overall economic growth, and in some cases concerned about the prospect of even deflation. Well, you have more hawks and a couple strong hawks on the Fed this year, on the FOMC this year as opposed to last year. So you might see the bar is higher this year than last year for to get some voting members such as Dallas Fed's Richard Fisher, such as Philadelphia Fed's Plosser, and I can't remember how you pronounce the guy's name, but the Minneapolis Fed president is also a noted hawk on the FOMC voting cast. So you've got an FOMC group this year that's less keen overall, less keen to do more policy stimulus. So and you can see it in the vote today. I'll scroll down and show you this. Voted against the action right there. Fisher, Coca Lakota is his name. Yeah, sorry, Coca Lakota from the Minneapolis Fed and Charles Plosser from the Philadelphia Fed. So the point is this, you had 3 dissenters, and by the way, 3 dissenters out of like 10 votes, that's pretty rare for the Fed. You don't see that very much. So it was a tough call just to get Operation Twist, just a relative shifting, of the Fed's balance sheet, of the Fed's treasury holdings. Oh, by the way, there was kind of a double twist because the Fed's also, taking, principal payments on its mortgage-backed security holdings and rolling them into, rolling into some, I believe, some agency debt. So Fannie Mae and Freddie Mac debt. So it's a little more than just the basic Operation Twist involving treasury securities there. Yeah, so in fact, they're shifting their balance sheet. It's a way. Here's the way I put it. And actually, I'll post this in the room. I was prepared for this because I'd explain this to my live coaching session, or my live coaching session. This was just a way to lower. Actually, I'll just say it. It was just a way to lower the long end of the curve, to lower long-term rates without increasing the Fed's balance sheet. So what the Fed could have done is effectively print money and use that to buy, say, 10-year notes and 30-year bonds. Instead, the Fed is, keeping its balance sheet the same, and instead of printing the money, it's taking some money out of the market. So think of the swap of money here. The Fed gives, say, to the primary dealers. the major banks that are authorized to buy treasuries from and sell treasuries to the Federal Reserve. So the Fed, you might say the Fed is essentially, dumping shorter-term denominated treasuries into the primary dealers and getting from the primary dealers cash, and then taking that cash and then buying longer-term treasuries. So it's like it's kind of a swap there. It's kind of a swap. There's no, at least on paper anyway, there's no really net major increase in the money in circulation. No, D, not exactly. D, consider the move they made last month. Last month, the key move they made there was a change of language in reference to the Fed funds rate. The previous language used by the Fed in reference to the Fed funds rate, which they've now targeted with a range. The range they targeted for the Fed funds rate, that's the main interest rate set by the Fed. They targeted that rate between 0 and 0.25%, and they made that move back in mid-December of 2008. Well, for the longest time, all they've said is they're going to keep that rate, the Fed funds rate, there between 0 and 0.25% for, and I quote, an extended period. So they keep saying an extended period, keep the Fed funds rate between 0 and 0.25% for an extended period. Well, they changed that in August. And then even that change, by the way, was there were even 3 dissenters for that change, the same 3 dissenters that voted against this Operation Twist move. But what they did agree, but there weren't enough votes to approve this change in language in regards to the Fed funds rate. So instead of keeping the Fed funds rate between 0 and 0.25% for a quote-unquote extended period, which in central bank speak is about 2 or 3 meetings, about 3 meetings. That's about 4 or 6 months. Instead of that, they've committed to keep the Fed funds rate lower for longer. We're talking like 2 years through the middle of 2013. So that in effect, sort of pins down the shorter end of the curve up to like 2 years. So right now you have a 2-year yield, a 2-year T-note yield trading like a 3-month yield did months ago. Yeah, money magnet, I agree. Yes, yeah, that's the head scratcher about all this money magnet. It's really strange that the Fed, in many ways, I can see the objections many have to what the Fed's doing, because this is not an environment conducive to banks lending. It really isn't with this flatter yield curve. So, D, does that make sense? The Fed's commitment announced last month to keep the Fed funds rate low for 2 years. That's going to put a lid on some sort of lid on any rise in the short end of the curve. Even though they're putting securities out there, their commitment to keep the Fed funds rate low is still going to put a relative lid on the short end of the curve. So they're effectively, they're not flattening the curve so much from the prospect of the short end rising and long end dropping. It's just more of maybe you get a slight rise in the short end, but it's more about the long end dropping. So again, what happened? I think Money Magnet asked the question about what happened. Why did the market do what it did? So we talked about that. In terms of what the market saw in the Fed and the FOMC statement, I made the reference to the significant downside risk. Again, my guess is the combination of disappointment that the Fed didn't do more, A, and B, the reference to significant downside risk to the economic outlook. And there's some other comments in there, but if you want to pin it on one comment, one phrase, one sentence in that FOMC statement, that was probably it. Significant downside risk. Again, it's kind of language you don't see much from a central bank like the Fed. So let's get to price action here. One thing I did as I was actually did a special session at FX Bootcamp covering the FOMC statement. This wasn't something I was asked to do. I wanted to do it. I was going to be at charts anyway. I wanted to hear what the Fed had to say and make some sense of it. So I just conducted an impromptu session at the FX Bootcamp and talked through what I was hearing and seeing from the FOMC statement and seeing from the market. So we talked about, again, at FX Bootcamp yesterday afternoon, New York time, the FOMC statement and what it meant and such. We're also watching price action. Well, I've got a chart here. I've got a chart here showing price action from early Wednesday through today's London close. You should see that chart right now. By the way, if I miss some questions, let me know. I will review the questions. But I have some material that I want to get through. and maybe the material I'm going through will answer some of your questions. If they don't, I will address questions later. So you should see a chart, an hourly chart for the Euro-USD currency pair, showing price action since the early part of yesterday's Asian session, Wednesday's Asian session, through Thursday's London close. And here's what I did. What I'm trying to impart here is, this is the way my mind thinks, and I'm not saying I'm the greatest mind, God's gift at Forex or anything, but as a quant, what drives me isn't so much, I'm not the kind of guy who uses all the fanciest statistical analysis tools. A lot of my work as a so-called quant, using basic stuff like, spreadsheets and so forth. And I tell you what, the one thing I feel is my advantage compared to most retail traders in the market, curiosity. And I cannot stress that enough, curiosity. And when it came to this move in response to the FOMC statement, I saw the magnitude of that move. It was a little more than 200 pip drop from the post FOMC statement high established near 138 down to the low established at 4 p.m. New York time. The low established just a little bit before 4 p.m. New York time. That low was just below 136, specifically 135.88. That was a 200 plus pip move. Now, if you've never watched many FOMC statements and the responses in the market, like on the Euro-USD to such statements, you might not have much perspective. But I've watched enough of these and saw this reaction over the course of a couple hours, or nearly a couple hours, and I thought, man, that looks big. That looks like a big response. I wonder how that compares to prior FOMCs. I mean, really, that's the question I was asking myself. How big is that move? How big is that move compared to just in raw magnitude, regardless of direction? How big is that move? That 200 plus pip move I've highlighted on the top of that chart. How big is that move compared to the Euro-USD's response to recent FOMC statements? I was thinking, let's look back to the FOMC statements or decisions since the start of the U.S. subprime mortgage crisis, which kind of came into being in August 2007. So that's what I did. I downloaded some data from GFT, and I did some analysis. I looked at the reaction from the FOMC release to 4 p.m. New York time after each FOMC statement, going back to, I believe it was August of 2007. And let me queue up what I found. Money Man, I figure your latest comment. We'll get to that. Thank you, though. So the move that I highlighted on that prior graph for the hourly chart, that is, for the Euro-USD, that 200 plus pip move I highlighted on the hourly chart for the Euro-USD, that's represented by this red bar on this bar chart. So again, yesterday, actually it was Wednesday afternoon, you saw a 200 plus pip move after FOMC from about 2:20 p.m. New York time to about 4 p.m. New York time. That exceeds any move in response to FOMC going back to August 2007. The exceptions, 2 moves, and some pretty significant moves in response to significant policy changes by the Fed. The first bar 1, a move of nearly 400 pips from the FOMC statement release to 4 p.m. New York time on March 18th of 2009. That was when the Fed expanded its original QE1 program by $1.15 trillion, a huge expansion of the QE1 program initially launched late the prior year, late in 2008. The second big response, this was the response to what I call ZIRP. The Fed announced its so-called zero interest rate program, or ZIRP program. Essentially, the Fed announced its intent to keep the Fed funds rate between 0 and 0.25%. The Fed announced that intent on December 16th, and you saw a sharp dollar sell-off. Euro-USD rose, and the reaction on the Euro-USD was north of 300 pips, north of actually 350 pips. So what I found striking was that this move over some, nearly 2 hours after yesterday's FOMC statement, it was actually a move of dollar strength in response to actually, if anything, a mild form of policy easing which in similar circumstances in the past would have prompted dollar weakness. So money magnet, to answer your question, I mean, it's a valid question. And, I suppose if you ask 10 different money managers or 10 different traders and 10 different economists, you might get 10 different answers. My best guess, money magnet, is that you say that this is all known and stuff, but my best guess is this, right or wrong, the market must have been spooked. Overall, the market must have been spooked by the Fed's assessment of the economy, of the economic assessment, plus disappointed that the Fed didn't do more. And I'm not saying wrong, but I'll bring this point back to you. If you or anyone else has a better explanation, I would seriously love to hear it. Really, I mean, that's my best guess. My best guess. Well, plus consider too that I talked about this earlier this week that the market's already already turned very bearish on the euro. In other words, very bullish on the dollar as well. I mean, that shift has been seen in the commitment of traders report from the CFTC. So, there might have been, some traders holding out hope that the Fed might do a little more, or some euro bears, waiting to see what the Fed would do before they would jump in and do more shorts. I don't know. Do I think that they're trying to make him do the QE3? Make who do the QE3, Ben? By the way, Money Mac, in this environment, in this context, it is very possible. It is very possible that we could see even more QE, so-called QE from the Fed. A more official, a more significant QE3 type program. As I see it, it's possible. And now, likely, yeah, I don't know. That's a tough call. But possible, yeah, totally. And one reason I say this because when you look at a major, especially a global financial crisis involving two of the biggest economies in the world, I'm talking about the U.S. and Europe, banking crises in both economies, and now this kind of shifted into a sovereign debt crisis. I mean, this kind of stuff, and if you consider the so-called deleveraging that U.S. consumers are going through right now, U.S. consumers overall accumulated too much debt, especially in the prior decade, and now paying down that debt. That process of deleveraging by consumers after a credit explosion and bust, that can take years. In fact, the typical recovery per se from a major financial crisis, from a major credit crisis, is I think Morgan Stanley does study on this. It's like 5 or 7 years. And, we're maybe like fourth or fifth inning right now in terms of an average response or recovery to a financial crisis. Yeah, Money Mac, I would agree with that. Yeah. And maybe my interpretation is that may be part of the story behind why the dollar, rallied so much, both, late yesterday afternoon New York time and then through much of today. You had and by the way, I'm going to get to the trade on the EURUSD in just a moment. There was a early London session trade, Thursday, earlier today for me, but yesterday for some of you. We're going to talk about trade on the euro. But, you think about, how you apply the druggy analogy, but it's actually a valid one. You think about it, how even markets work and how the markets been sort of like brought up in the past, 2 or 3 years or so, on different forms of stimulus, monetary policy stimulus from central banks, maybe fiscal stimulus in some cases, sometimes from governments. And at some point, it can only go so far. At some point, the market's either not going to be satisfied with what it gets, or whether it's a country's central bank or a country's government, you reach a limit. And maybe we have a market that's just expecting more and more and more, bigger and bigger quantitative easing programs, and this time they didn't get it. But, it may be only a matter of time before it gets one. But my point is this with regards to the magnitude of that move. When I saw the reference by the Fed, by the FOMC, in the FOMC statement, the reference to significant, deterioration in the economic outlook, significant economic downside risks. When I saw that and when I saw the reaction, my first thought was, London's going to step in. And what are they going to do with it? It's a very good possibility London steps in, buys the dollar, and of course in turn, sells the euro. Let's look at a chart for the EURUSD. I'm going to switch this graphic to a chart for the euro. Oh yeah, Jason mentions Wall Street and the middle class, and oh man, some of the things that are evolving right now. It's actually a great time to be a trader, a fantastic time to be a trader, and it's arguably a tough time to be a lot of other things but a trader. I mean, not everything, but a lot of other things. I'm sorry, have some of you seen the unemployment levels of, say, young adults of just out of college up to age 25 or 30? The unemployment rates of young people in many developed economies it's horribly high. I mean, you think that's not going to have an effect over time? I mean, we're talking about we're talking about an entire generation of young people are going to be are permanently affected by lengthy joblessness period. Anyway, here's the EURUSD. This is a 3-minute chart. As some of you may know, I like a 3-minute chart because it's for me anyway. It just sort of fits my eye. I like the way it says it fits my eye. It's granular enough. It's granular enough that I can see intraday levels of support and resistance, but it's not so noisy, at least for me anyway. It's not so noisy that I can't make sense of it. So I like using a 3-minute chart to identify support and resistance. Now, you could argue that price action today on the euro, it wasn't necessary to use the 3-minute chart, but again, it's something I tend to gravitate towards, this 3-minute chart, so I'm going to use this. Now, what I'm showing on the upper left-hand portion of this chart is price action, which seemed to find a ceiling around 35.70. You had a moment about, as I recall, about an hour before London opened. The euro found resistance around 35.70. You can see a horizontal black line at the top of the chart representing 35.70. So about an hour before London opened, the euro turns at 35.70. Minutes before London opened, the euro tests 35.70 again. It holds. And then about 30 minutes after London opened, the euro tests 135.70 again. It holds. You could have been short, if not right there at London open, around 35.70. Then on the second test of 35, or the third test, I should say, of 35.70, about 30 minutes after London session opened. That, in my mind, was a viable short. In the context of, the price action since the FOMC statement, and, what it implied for, maybe for prospective future policy that the Fed may be doing smaller steps now, and who knows, may not do much more beyond this. And by the way, another thing to keep in mind, I didn't mention this, and I've mentioned this before, I believe, in the Women's webinars, but it's worth mentioning again. Bernanke made a reference in his Jackson Hole speech late last month. Bernanke made a reference, and I can't recall the exact words, but to paraphrase what he said, Bernanke essentially said that it was his view, and probably the majority view at the central bank, especially of the so-called inflation hawks, like Fisher, like Plosser. Bernanke's view that he expressed was that a central banking policy or monetary policy had just sort of reached its limits in the U.S. He essentially said that there wasn't a whole lot more that he thought that policy could do, monetary policy could do, and he said in a fairly direct fashion that it was time for Congress and time for the Obama administration to do something. It was time for them to step up. Maybe provide some fiscal stimulus or do some structural reforms or beef up education, whatever. So, one interpretation is this, the hint by Bernanke that, we're nearing the end of the effectiveness of monetary policy, of central banking policy, of central banking moves. And yet, even though they delivered something, the so-called Operation Twist, it certainly wasn't QE3. Now, I want to be clear that the Fed has been adamant that it's prepared to do more if absolutely necessary. But I think what the Fed is saying is that, we don't want to do more, and we think doing more is, or mostly a lot of people at the Fed think doing more is not going to pack much of a punch in terms of having a meaningful effect. Yeah, so the normal bullets analogy, very, very valid, very valid. Again, you could argue they could do more. They can probably print infinitely, but they're already admitting, the Fed is already admitting that it's the power of monetary policy. It's losing its punch. It's losing its punch. So the trade on the euro, the euro short around 35.70. Logical profit target the short. I'd say check your daily charts on this. Check your daily charts. There was a couple of highs. The highs on a couple of days in December, and the high on a day in early January, plus the low for February. Those highs in December and January, and the low in February, all within about 10 or 12 pips of the 34.30 level. So check your daily chart for the euro and notice how price action had seemed to respect the 34.30 level back then. So you had a combination of the EURUSD reaching just before today's New York session open, what seemed to be an important level early this year and late last year. Also, the weekly S2 pivot point was just below that 34.30 level. So that was a logical profit target for the short. And by the way, after that, the euro sort of ping-ponged around, a little bit up, a little bit down. But the euro really didn't go anywhere today, or during today's New York session, that is. And by the way, it's no surprise. One thing I've noticed when it comes to the currency market, especially as it pertains to the EURUSD, I don't know how many of you have noticed this, but it's not a strict rule of thumb that I apply without exception. But I seem to notice when you have a reasonably strong London session move in one direction, when you have a reasonably strong Asian session move in one direction, and then a similar or even bigger move in London session. So when Asian session moves down, for example, then London session moves down in an even bigger way. And especially in the course of those moves in both Asian and London session, we reach logical profit targets. In this case, like a weekly S2 and significant levels, in this case, multi-month lows, a level that was important earlier this year. I mean, what you're left with in the New York session, usually scraps. You get scrappy price action, sort of choppy, maybe even a bit of a recovery or a bit of an opposite move, in this case up after the move down earlier today. That's pretty common. And that's pretty common. I think that's where a lot of traders get in trouble. They, after a move is played out like that, they expect more of the same. And sometimes that happens, but far too often it doesn't. Far too often a move is played out and it's done, and traders are still trying to do the same thing when the trade's over, essentially. So, folks, by the way, if I haven't answered if I've missed some questions, I apologize. Now's a great time to ask them again, or I can scroll through here. I'm moving ahead. There's nothing much coming up tomorrow in terms of the news that I'm aware of. One of you mentioned earlier, I think it was Money Magnet. One of you mentioned earlier the G20 meeting starting. I believe it started today, but it's certainly going on tomorrow and over the weekend. Folks, I don't know when was the last time anything meaningful came out of a G20 meeting. By the way, this is the so-called Group of 20 Industrialized Nations meeting over the weekend. I think actually there's an IMF meeting as well, I thought. But, I don't know, maybe it's just me, but I cannot remember the last time a G20 meeting produced anything significant. However, you might consider a source of event risk. Maybe a statement from the G20, especially in the context of the mess we're still dealing with in Europe. Maybe something meaningful comes out of the G20 meeting. I rather doubt it. But I'm open to the possibility. By the way, quick look at some things today. I guess I'll wrap this up. Some interesting price action in multiple financial markets. SocGen, the major French bank, down sharply since its July 1st highs. Same with BNP. I'm sure many of you have noticed the levels now seen on the U.S. 10-year Treasury note, also the Germany's 10-year Bund. U.S. 10-year T-note, I believe, printed a 1.70 handle today. Amazing. We're talking about like 60-plus year lows. Yeah, they need it. Erwin, they need it. In fact, I believe there's still some talk about Erwin, you recall, have you heard of the so-called TARP program, the Troubled Asset Relief Program, that was put in place by the U.S. to boost, to give the U.S. banks some help? There's still some talk about like a Euro TARP program, but maybe it's just me, but I didn't sense the Europeans were too thrilled about the idea. U.S. Treasury Secretary Geithner, who was sort of an architect of that program for the U.S. banks, Geithner made a trip last weekend to the so-called ECOFIN meeting, I forget what you call it, to the meeting of finance ministers in the Eurozone in Poland last weekend. And I got the impression that, Geithner shook some hands and maybe kissed some babies, but, I got the impression, especially from German officials, that they weren't, overly impressed with, here's the deal. and many of you know this, the U.S. has a reputation problem right now. The U.S. has, and rightfully so, has a reputation problem right now. There was a day, it wasn't that long ago, a few years back, before this financial crisis brewed up. There was a day when it was the U.S. telling others, like, as I recall, remember the Asian crisis back in the 1990s? The U.S. was kind of shaking a finger at some of the Asian economies and telling them what they should have done or should do. But the U.S. isn't in that position right now. So, part of it could be just, hey, who are you to tell us what to do? And think about it. The other part of it is that there's politics at play here, making for some hesitation, for some butting of heads when it comes to tough decisions that arguably need to be made here in the U.S. And there's certainly plenty of that in the U.S. Plenty of that in Europe. And by the way, the structure of Europe, not good for making quick decisions. And when you're in a crisis mode, when it comes to sovereigns or when it comes to banks in Europe, there's some times when some quick decisions need to be made. And if you want to give a nod of credit to the U.S., you had some people in place in the U.S. and sort of a structure in the U.S. where some quick decisions, right or wrong, could at least be made. Quick decisions are not the way Europe is set up right now, not the way the Eurozone is set up right now. So Euro, I've seen some of the estimates I've seen on the amount of funding needed by Eurozone banks. Let's put it this way: there's been talk about the EFSF, the European Financial Stability Facility, the rescue fund that was established in May of last year. There's been talk that needs to be more like 2 trillion euros. And right now, it's actually the Eurozone, the 17 Eurozone countries have yet to approve the agreed to increase from July to up to 440 billion. Let's say Europe has a long way to go. And maybe they're going to fumble their way through it and get there, but and maybe when push comes to shove and if things get bad enough, they will find a way to act quickly, and maybe Germany will give in. But arguably the key is Germany there. The key is Germany. So I'll say the same thing I've been saying a lot lately, which is at this point we're kind of past the one main source of event risk, the one key news event this week, which started the FOMC. Oh, I can tell you one thing right now, and I'll talk about this. There is, I believe it's next Thursday. Next Thursday, there's a bond auction, an Italian bond auction. So the government of Italy is scheduled to conduct a major bond auction, sell Italian government bonds in an auction. There's some chatter. There's some chatter amongst likes of economists and analysts and even some traders and money managers that that bond auction might fail. Now, maybe it's not going to be this one. Maybe it's going to be another one, or maybe it's going to be months before the Italian bond auction fails. But there's I would say, a non-trivial possibility that we're facing the prospect of a bond auction fail. Now, what would that mean? I don't know how much. I haven't seen how much yet. Italy's scheduled to sell, scheduled to auction off at that bond auction next Thursday. Let's say it's 5 billion. Let's say it's 5 billion euros worth of Italian bonds. And a failed bond auction essentially would mean rather than getting bids for 5 billion bonds, they only receive bids for 4 billion or 4.5 billion. In other words, they fail to sell all of the bonds. If we see a failed bond auction in Italy, look out. Boy, it could get ugly. It could get ugly. Oh, come on, Money Magnet. Be a sport. Chip in a little bit. Okay, Money Magnet, I have an idea, Money Magnet. If you don't want to buy an Italian bond, at least buy a pizza. At least buy a pizza. Maybe with my money. Yeah, good one. Yeah, good one. Touche. Well, folks, that wraps it up for me. I'll stick around as long as FX Street has the room open. I'm not going to stick around any longer than say 10 or 15 minutes. But if anyone has a question they posed earlier and I missed it, I apologize. I'll be happy to answer the question with a typed response to the room. But again, thank you very much for everyone who attended this event. Thank you especially to FX Street. I know I'm sure some folks at FX Street are up very late for them to monitor this event. So I really appreciate the time you've taken here. And the same to all of you. I mean, every one of you have invested time in attending this event, and I hope for each one of you that the time invested in furthering your education about the financial markets, hopefully furthering your education as a trader, I hope that sooner rather than later it pays off. But it may not be sooner. It may not be sooner. Be patient. But this time invested should go a long way. Should go a long way. And by the way, thanks to all of the comments about what each one of you are seeing, because listen, I do, one reason I like doing these events, I'll end with this note. One reason I really like doing these events, I learned something too. I mean, I have access to lots of sources of information, media sources, newspapers like the Wall Street Journal, Financial Times, Telegraph, yada, 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 CNBC, all sorts of, blogs. I have access to a lot of stuff. But you know what? I've only got so much time. I've only got 2 eyes. I've only got 2 ears. My fingers can only type so fast. My mouse, I can only click my mouse so fast. I don't catch everything. I pick up plenty of good stuff from the likes of some of you attending this event, from the likes of our members at FX Bootcamp. So it's one of the reasons I do this. It's a learning opportunity for me too. Folks, have a great evening or day or morning wherever you are. Cheers.